Hello and welcome at Value Investing, where we try to estimate the intrinsic value of different companies. As I'm not feeling too well, my voice is a bit different in this video. I'm sorry for that. As usual, the disclaimer: this is no financial advice and just my personal opinion. And now let's hop right into the video. In today's video, we will have a look at Realty Income, ticker symbol O, which is currently trading at around $54 and down around 15% over the last year. We can see they are almost trading at a 52-week low, and they have a nice starting dividend yield of 5.7%. If you do not know Realty Income, let's have a look at the latest investors presentation. They have a pretty strong diversified real estate portfolio with 1,300 clients in 85 industries, and they are also diversified across the globe. Additionally, they have one of the best credit ratings, that is AAA or A- by Moody's and S&P's, which gives them a pretty powerful moat in their business. Now let's have a look at their clients. So they are very strongly diversified, and their top clients are Dollar General, Walgreens, 7-Eleven, and also CVS Pharmacy, Lowe's, FedEx, so pretty well known and healthy companies. Here in the corner you can see the geographic diversification. So they have 10% in UK, 10% in Texas, California, Florida, and so on. And also the diversification across industry types. So they have 82% in retail, then industrial, gaming, and others. Now let's have a look at the occupancy rate. And we can see that here at the bottom, Realty Income has an average occupancy rate of 98%, which is way higher than the median S&P 500 REIT. They also have very long leases, so here we can see the lease expiration over time. This looks pretty healthy. And additionally, after a lease expiration, in this graph we can see how they have raised their rents, which looks also very promising. One problematic point from my point of view is the debt maturity profile. So in 2024, they have to refinance a lot of debt, which is kind of unlucky in the current market conditions. Now, let's have a look at Realty Income with the stock valuation tool. I've plugged in all the values for Realty Income, and one thing which you can immediately see is the payout ratio with over 200%. Which is very common for REITs. Nevertheless, let's have a look at it. So a better way to judge if the payout ratio is healthy for a REIT compared to normal companies is to look at the AFFO payout ratio. The AFFO payout ratio in the trailing 12 months and also the forward-looking AFFO payout ratio is around 76%, which is very healthy. Now let's have a look at the multiples valuation based on AFFO. As comparable companies, I have used WP Carey, VG Properties, especially because they are now expanding further into the gaming industry, NNN REIT, Kimco Realty Corporation. I've plugged in all the values, calculated the price to AFFO multiple, and from that also the average price to AFFO multiple. And with the AFFO per share from Realty Income, we get an intrinsic value of around $52. Now let's have a look at Realty Income with the dividend discount model. To say something about the dividends for Realty Income, they have grown the dividends 25 years, which makes them a dividend aristocrat. And one additional point which I personally like about this company is they pay out the dividends monthly instead of quarterly or annually. This is also why they are known as the monthly dividend company. I've plugged in all the values for the yearly dividends and calculated the average growth rate of around 4.3%. For the future, I projected a lower growth rate to have a bit more margin of safety of around 4%, which gives us an intrinsic value of around $69. One thing to keep note of is also the outstanding shares as usual. So we will have a look at that. Please keep in mind, REITs have to expand their portfolio, and as they have to pay out a big margin of their earnings, they are limited in option how to acquire new properties. One option is to take on debt and then buy new properties and expand further. The other option is to dilute your shares. Realty Income in the last 2 years has diluted their shares more or less heavily. This is reasonable as the current market conditions are not in favor of taking on debt, so I think they are kind of left without many options. This is probably also why the share price dropped a bit, but anyway, this is very common for a REIT, so I think that's not really an issue. Now let's have a look at the output tab. As usual for REITs, I have left out Graham's valuation and also the discounted cash flow analysis as they are not applicable. So we are left with the multiples valuation based on the AFFO and also the dividend discount model. If we average those together, we get an intrinsic value of around $61. As the current trading price is $54, we could buy in with a margin of safety of around 10%, which is pretty uncommon for a REIT like Realty Income. But anyway, I would like to know what you think about this company, the current market situation, and also which company you would like to see next. Please leave a comment down below and also like and subscribe this video. This would really help me in growing my channel and producing more content. And as always, this is no financial advice, just my personal opinion. And thank you for watching.